Hello, and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following us on hashtag QC Weekly Comment on LinkedIn. I'm your host, Caroline Langley, an investment director and deputy fund manager of our climate asset funds, based here in our London office. And this week, I am pleased to be joined by Richard Carter, our head of fixed interest research, and Phil Ross, who has recently joined the business here in London as our utilities analyst. Good morning to you both. So, in my role on our climate asset funds, one of our 5 investment themes is clean energy. And so I have a strong interest in closely following the renewable energy sector. And one of the ways we've been investing in this theme in recent years is via the renewable energy infrastructure investment trusts. But sadly, these have had a very difficult time over the same couple of years. And one of the reasons behind this is the very high interest rates we've had, because one of the attractions of this asset class has been their high, generous income returns. And now we've had high returns on cash and government bonds with very little risk. These trusts have been struggling, and the discounts have widened between their net asset values, the underlying asset values of the investments in the trusts, and their market caps. So with this, we're keeping a very keen eye on the interest rate expectations to see when this trend could reverse. Of course, it has wider implications for all risk asset pricing, but these trusts are particularly sensitive to the news. So, Richard, in this context, has anything changed this week with regards to interest rate expectations?
Good question, Caroline. I wouldn't say it changed hugely over last week. I mean, what we've got at the moment is this huge trade and tariff uncertainty. No one quite knows what Trump's policy on it's going to be from one day to the next. So we don't know that, and we also don't quite know what the impact of all the uncertainty is going to be on the economy. So it's quite a tough situation for central banks at the moment, really. I mean, I'd say although rate expectations didn't change much last week, it does look like rate cuts are on the way fairly soon, particularly in Europe, where the ECB has been cutting rates aggressively anyway, but also the Bank of England, where the market expects them to cut at the next meeting in May. And it's, if the trade uncertainty carries on, the impact on the UK and the European economies is going to be weaker growth and potentially, depending on exactly the sort of response, potentially weaker inflation as well if the currencies, the euro and sterling, continue to appreciate. It's a tougher job for the Fed, much tougher job, because although unemployment may go up and growth may weaken, inflation is going to go up as well as the tariffs push up prices. So it's a tough job for the Fed. Latest comments from Fed officials suggest they may be open to rate cuts if the data worsens, but I think they'll really want to wait and see what the impact on inflation and unemployment is. The market does expect them to cut rates as the year goes on, but as I say, it's a more easy sell for the Bank of England and the ECB to be cutting rates than it is the Fed.
You mentioned along the way there tariffs, Richard, and consequently how difficult it is in the US right now. But with this on-off tariff news and the uncertainty skyrocketing, I've become really interested in this difference between the soft data and the hard data and trying to find out what each is trying to tell us, because this seems really key for investors. So for those who aren't familiar with these terms, soft data refers to sort of surveys, elements like consumer confidence, business outlooks, the purchasing managers indices, PMIs, and these track the sentiment, and all these things help us to sort of crystal ball gaze the future. Basically, if people aren't confident, there's a risk that they won't be going out and spending. Conversely, hard data is backward looking, so giving us facts about what has actually happened. And this comes from stuff like factory production levels, US jobs data, earnings releases from companies, and the GDP readings. These allow, tracking of trends too, but they're sort of firm factual data points that we can use to extrapolate the trends and help us guide to sort of future predictions. So PMI survey data will capture this weaker sentiment due to this uncertainty. And this seems to be what we've seen this last week. Richard, can you tell us the whole story about this?
Yeah, it's interesting what you say about the sort of hard versus soft data. You're absolutely spot on. It should be, the sort of uncertainty and potential slowdown in growth should be showing up in the soft data generally, and certainly things like consumer confidence readings have not been great. I think in the last few years, maybe, you do tend to get these movements in the survey data, and then lo and behold, particularly in the US, the kind of jobs market sails on without any great trouble. Consumers keep spending, and all the sort of worries when people look at the soft data never sort of materialise. It potentially could be different this time if the tariff and trade uncertainty carries on. Certainly, the latest PMI data wasn't brilliant. I would say across the board. I mean, it was weaker in the States, particularly weaker in the UK, and also eased off a little bit in the Eurozone as well. So there's certainly a few alarm bells ringing, but I wouldn't say any of the readings really yet point towards a sort of recession or anything like that. So it's still early days. I think the Fed in particular will want to wait and see what happens to the hard data. Things like non-farm payrolls are critical. We've got the latest reading of non-farm payrolls out this Friday, actually. So the market will be watching that closely. We've also got the ISM coming out in the US as well, which is another sort of PMI survey that's very closely watched. But yeah, as I say, we're still in this world where the soft data is weakening, but the hard data is still holding up okay.
Well, I'm really glad to hear the hard data's still holding up at the moment. And yeah, fingers crossed for those readouts over the week ahead. And also we'll start getting some insights from what the companies are experiencing through their earning releases too. So, I mean, one of the reasons why these tariffs have been creating and triggering this great uncertainty in markets has been this very aggressive manner that Trump has been announcing them, and moreover, the extent of the tariffs. And one of the ones that caught my eye, one of the most eye-watering tariffs that's been mentioned to date has been the phenomenal 3,521% tariff on Cambodian solar panels, which is really quite eye-watering. Trump really seems to have it in for the Cambodian solar manufacturers with this particular tariff. So I was really interested to try and find out what was behind this. And I learned that the history behind this phenomenal rate actually predates Trump. There was an investigation that began a year ago when American manufacturers of solar panels accused Chinese companies with factories in Malaysia, Cambodia, Thailand, and Vietnam of basically flooding the market with subsidized cheap goods. And the reason why the products from Cambodia will face the highest tariffs now is because its companies did not cooperate with those US investigations. And as things stand, the Malaysian tariffs would be a mere 41%, and the Thai tariffs 375%, on these particular products. And there's basically, a different government agency, the International Trade Commission, which is due to make a final decision on these tariffs in June. So of course it could all change, but really was quite something. So we've had some results from NextEra, the largest utility company in the US over the last week. It put out its first quarter numbers. Now, NextEra isn't investable for climate assets, which is the strategy that I'm closest to, because this is designed for clients with a dedicated responsible investment preference, and that excludes coal and nuclear as part of the exclusions. But nonetheless, I was extremely interested to hear from Phil, our utilities analyst, about the impact of these eye-watering tariffs in their large renewable business. Even though renewables is only about 1/3 of what this large utility company does, it is still US's top renewable energy company by size. So it gives a really interesting perspective on the impact. Phil, can you help me out?
I will do my best. Good morning. So yeah, NextEra results last week were super interesting, and most of the discussion was away from the numbers and more on tariffs, as you might expect, given how topical that subject has been. Generally, the tone was that they were quite relaxed about the potential impact of tariffs, and there are three main things that they spoke about, or three main objects rather, that NextEra imports. Firstly, on batteries, NextEra thinks that because of their size, they're likely to be pretty unique in having a domestic-only US supply chain for batteries. So on the non-renewable side, they are the biggest provider of energy in Florida, which is one of the biggest states. So that gives them some clout. And they do think that if tariffs come in actually on batteries to a meaningful degree, they think they might actually benefit from tariffs, which I was surprised to hear, given that they expect their smaller, medium-sized competitors are likely to be importing batteries from China. So they will either have to pay the tariffs or they will have to re-engineer their supply chain, which will take some time and will obviously cost them some money. The second thing that the NextEra spoke about, or the second object, if you like, that they would import or potentially be subject to tariffs on, was gas turbines. They said gas turbines actually are fully sourced in the US and are also assembled in Florida, which helpfully for them, they pointed out, was a red state, which they think, I guess this is sort of a soft data point, which could give them some protection a bit further down the line. And then lastly of the three things was solar panels, which you may mention, Caroline, in your introduction. NextEra said these were purchased from countries outside those four most affected by tariffs. They mentioned Cambodia, Vietnam, Malaysia, but actually NextEra has done some work, and we spoke about the fact that solar tariffs aren't a new thing. So a lot of companies actually in the US have had some time to get ahead of the tariffs on solar panels. So overall, what they said is that the total impact of tariffs at the moment would be just 0.2% of their CapEx pipeline. It's a big CapEx pipeline. It's $75 billion, and 0.2% is about $150 million. But actually, even that said, they were hoping that they could negotiate some of these terms with their suppliers and reduce that figure to an even lower point. So, I was quite surprised to see them so kind of relaxed and positive about tariffs. And on the day, the shares actually reacted marginally well to that news. There is still a little bit of uncertainty hanging over the renewable sector, given what the Trump administration may or may not do with the Biden-era IRA Act. So there's still a bit of uncertainty, but it was certainly helpful on the day to hear some comfort for investors in NextEra anyway around the potential impact of tariffs.
Thanks, Phil, and really reassuring that NextEra gave us this information and all didn't seem quite as bad as perhaps we'd feared. Do you know anything about how other companies are faring?
Yeah, it's a good question, and I think exactly the right one to be asking. What's we call it the read across? What can we learn from NextEra's results that we might apply to other companies? I guess the short caveat is that earnings season has really just started for the utility sector, so we haven't heard a huge amount from 1Q results from companies, but tariffs are not a new thing, right? The administration's been in place since we had the result in November, obviously moving in January, so we have had weeks and months of noise around this. One company that's maybe worth mentioning is EDPR. based in Portugal. The statements their management have been making have also been quite relaxed on tariffs, actually. So going back through some of their documentation, they talk about solar panels as well. Solar panels that EDPR uses are manufactured in Louisiana and Alabama. Again, you mentioned that solar tariffs are not a new thing. It was actually the Obama administration that brought these in initially more than 10 years ago. So I guess we would expect solar to be relatively well insulated from the overseas tariff exposure. Batteries, again, EDPR said that their batteries are made in the US. So, very small chance of being exposed to cost increases from tariffs there. And actually, when they look ahead to their capex pipeline, they haven't quite given us a number yet in the same way that the next era did, but they said their 25 to 26 supply chain is pretty much 100% secured with a very high local weight. Now, high they didn't seem to quantify, but if I had to guess, I'd probably guess in excess of, say, 80% of that 25, 26 supply chain would be US weighted. And then maybe one other quick example was Iberdrola, another European energy company with a big utilities tilt and a big tilt towards the US. Iberdrola had said a few weeks back that 82% of their suppliers for these kinds of renewable equipment were local, and they expect, I think the words they used were virtually no impact. So quite a lot of comfort coming from the Europeans in recent weeks. In the next week or so, we will hear from them on 1Q results. I expect we'll get a bit more kind of hard data. But yeah, I was sort of pleasantly surprised that the impact seems to be less than might be feared for this very important sector.
Oh, I feel like I can sleep at night now. Thanks, Phil. Well, thank you both for those great and interesting insights, and thank you all for listening. Did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at QuiltAchieveIt. To make sure you don't miss future episodes, tap the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltachieveit.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website and our social media pages. Finally, do you have any questions you'd like to ask one of our experts in our next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you, Richard and Phil, for your time today, and all of you for listening. See you next time.